Hello. Today is Sunday, June 7th, 2026. Here is your daily signal. Gold prices have plunged, according to Bloomberg, as robust U.S. jobs data has prompted renewed speculation about Federal Reserve rate hikes, rippling through both the bullion and bond markets. Gold prices and mortgage rates remain highly sensitive to U.S. jobs reports and broader bond market activity, often shifting rapidly as economic conditions change. When the U.S. labor market outperforms, such as May's addition of 172,000 jobs over double expectations, investors anticipate tighter Fed policy and higher yields. Trump's sweeping tax and immigration megabill is compelling the Treasury to flood markets with new debt, forcing 10-year yields higher and keeping mortgage rates at 6.48%, as Fortune reports. The near-term outcome: gold prices look set to remain under pressure, while mortgage rates may stay elevated or even rise, since sustained government debt issuance is lifting bond yields. This dynamic could dampen consumer spending and slow housing market activity, with persistent fiscal deficits increasing volatility in gold and bond markets, impacting investment and lending well into the medium term. Next, onto market risks in technology and equities. Ray Dalio, as covered by Fortune, has warned that U.S. stock markets are approaching bubble levels reminiscent of 1929 and 2000, with the risk of a debt crisis now past the point of no return. Debt accumulation, paired with liquidity tightening, has many analysts referring to historical bubbles as benchmarks for today's equity markets. June 5 saw tech stocks tumble. Nvidia dropped 6.2%, Broadcom fell 7.9%, and Micron Technology slid 13.3%, marking the worst session since October. Market volatility is on the rise, especially as traders lose hope for a rate cut. In the near term, sharper price corrections for major tech names could trigger institutional investors to shift portfolios, spurring further sell-offs. Looking further out, prolonged liquidity tightening and an absence of rate cuts may exacerbate systemic debt risks, with broader economic contraction possible if corrective measures aren't taken. Next, we turn to a major industry move in tech and space infrastructure. Google will pay SpaceX $920 million per month for compute resources, as reported by TechCrunch, marking one of the largest enterprise deals in the tech and space sectors. The announcement comes just a week before SpaceX's highly anticipated IPO and puts both companies at the center of innovation in cloud and space-based infrastructure. This partnership is set to escalate SpaceX's enterprise services and place Google firmly ahead in AI and data infrastructure by leveraging SpaceX's compute capacity. Investors and institutional buyers are closely watching, with the deal poised to rapidly boost SpaceX's valuation and confidence heading into the IPO. In the short term, this could pressure other cloud industry giants to seek comparable partnerships, while in the medium term, SpaceX may emerge as a significant player in tech infrastructure, shifting the balance of power across industries. Now, onto the markets. International equities were broadly lower, with Taiwan posting the steepest decline at over 7%, while Germany, France, and China also slipped notably. The Netherlands and Japan saw marked drops, with losses of about 3 to 4%. Commodities moved mostly lower, led by silver, platinum, and uranium plunging between 6 and 9%. Gold, oil, and copper also posted declines, while agriculture and carbon edged down marginally. Among sectors, semiconductor stocks fell over 10% as stocks retreated sharply, but real estate and financial stocks were marginally higher, with XLRE and XLF both up slightly. The S&P 500 lost about 2.6%, while healthcare eked out gains, supported by Roman 45 rising just over 0.6%. Among today's movers, Springview Holdings surged over 100%, while Nuwellis tumbled nearly 65% as today's top loser. That's it for today. You can find more news and details on our website. Goodbye.